Imagine for a second that you are walking into a coffee shop. It's early morning, sun is just coming up.
Mm-hmm.
Maybe you're in downtown Las Vegas, surrounded by the neon hangover of the Strip.
Mm.
Or perhaps you're in a busy, polished hotel lobby in New York City. You're groggy, you haven't had your caffeine yet, and you walk up to the counter expecting the usual routine, you know the drill.
Oh, yeah. The standard 7.0 a.m. friction.
The human element, for better or worse.
Exactly. You're expecting a barista who looks like they've been on their feet for 8 hours, maybe a bit stressed, maybe checking their phone, maybe getting your name wrong on the cup.
Happens every time.
But instead, today, you are staring at a dual-armed humanoid. And here's the kicker. It's not just a statue or a glorified vending machine. It sees you. It tracks your movement.
Okay.
It waves. It remembers that you like oat milk in your latte extra hot, no foam, and it starts making the drink with absolute perfect precision while making a little small talk about the weather.
It sounds like a scene from a sci-fi novel set in, like, 2050, doesn't it? Like something out of Asimov. It really does. But it's not. It's January 2026. This is happening right now.
Right now.
The company behind it is Richtech Robotics, trading on the NASDAQ under the ticker RRR. And that brings us to the big question we're wrestling with today. The robot is undeniably cool, it's flashy, it draws a crowd, but does it actually print money? Is this the next tech titan that's going to define the decade, or is this a bubble about to burst?
That is the multi-billion-dollar question. Because cool doesn't always equal profitable. I mean,
yeah.
history is just littered with cool tech that went bankrupt.
Welcome to the Deep Dive. Today's Tuesday, January 27th, 2026, and we have quite a show for you. Our mission today is to strip away the hype.
There's a lot of it.
A lot of it. We're going to look past the flashing LED lights and the dancing robots to look at the cold, hard numbers through a disciplined value investing lens.
And we have to be disciplined because as we've been reviewing the source material, the numbers tell a very conflicting story. On one hand, you have a valuation that suggests world domination.
Right.
On the other hand, you have revenue that looks like a small local business.
Yeah.
It's a paradox.
And spoiler alert, we are going to find a massive disconnect between the company's unicorn status and its bank account. But, and this is a huge but, there is a partnership announced today that changes the entire calculus.
It really does. It flips the script completely. It changes the narrative from a hardware story to something much, much bigger.
So why are we talking about this today specifically? Well, if you've looked at the charts, you know why. The stock is going absolutely parabolic today.
It's a rocket ship.
We are seeing it up roughly 43% to around $5.46.
That is a massive move for a single trading session.
Yeah.
I mean, that's the kind of move that makes headlines and, frankly, wakes up the algorithms.
And it's not just random noise. We have a specific catalyst. Confirmed today, Richtech is partnering with Microsoft's AI Co-Innovation Labs. Now, I want to pause here because we hear AI partnership thrown around a lot. Every company seems to have an AI strategy these days.
It's the buzzword.
Why is this one different? Why did the market react so violently to this news?
This is significant because it's not just about generative AI, which is what we spent the last few years talking about, like chatbots, writing poetry or generating images. This is about agentic AI.
Agentic AI. Okay, let's unpack that. I feel like that's a term that's going to be the buzzword of 2026. What does it actually mean in this context?
So think about generative AI things like ChatGPT. It creates content. It predicts the next word in a sentence. It's reactive.
Right. It responds to a prompt.
Exactly. Agentic AI acts. It perceives a chaotic environment, like a busy kitchen where people are moving, things are dropping, steam is rising, and it reasons through physical tasks. It's proactive.
So instead of just writing a recipe, it can actually cook the meal.
That's the perfect analogy. It allows the robot to make decisions on the fly without a human scripting every single movement. If a cup isn't exactly where it's supposed to be, a standard robot fails. It just grabs at thin air.
It gets an error and stops.
Right. An agentic AI sees the cup, understands it moved, and adjusts its arm to grab it. It essentially gives the robot a brain that can handle the messiness of the physical world.
And this partnership, it validates Richtech's hardware with Microsoft's absolute top-tier software muscle.
That is a huge stamp of approval. And speaking of stamps of approval, we also have to talk about the institutional endorsement.
Oh, yeah, the big one.
Just a few days ago, on January 21st, filings showed that BlackRock, the biggest money manager on the planet, took a 7.1% passive stake.
That is over 11 million shares.
When BlackRock loads the boat like that, It signals to the rest of the market that this isn't just a garage science project. It provides a level of legitimacy that is, frankly, hard to ignore.
You're right. BlackRock doesn't usually make bets on vaporware. They are the adults in the room. When they show up, other institutions pay attention. And finally, just to set the stage fully, they cleared up a scary regulatory issue regarding a delayed 10K filing, which had everyone nervous a few weeks ago. So the air is clear, the partners are massive, and the stock is flying. Let's get into the details. Part 1, Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding.
Right.
Let's start with how this company actually makes money. Because if you looked at them 2 years ago, the business model was completely different.
Oh, completely different. I mean, historically, robotics has been a CapEx or capital expenditure business. You build the machines, you sell it to a customer for, say, $50,000, and you walk away.
One and done. You hand over the keys and say, good luck.
Exactly. And that is a tough business. It's lumpy. You have a great quarter where you sell 10 robots and then a terrible quarter where you sell 0 because the economy dipped or interest rates went up. It's so hard to scale that with any predictability.
Inconsistency.
None. But moving into 2025 and now 2026, Richtech executed a strategic pivot that is absolutely central to our conversation. They shifted to RaaS.
Robots as a service.
Right. And if you're a value investor or if you just follow Warren Buffett, you know that recurring revenue is the holy grail. Instead of asking a coffee shop owner to drop $100,000 up front, which is a huge ask, especially for a small business operating on thin margins, you lease the robot to them.
So it's just a monthly fee, like a subscription, like Netflix, but for a waiter.
Yes, precisely. The hotel or the restaurant pays a monthly fee to use the robot. This lowers the barrier to entry for the client significantly. They don't need a massive loan to get started.
Right, they can fit it into their operating budget instead of their capital budget.
You've got it. But for Richtech, it creates a steady, predictable stream of cash flow. It turns a one-time sale into an annuity. A beautiful, growing annuity.
It solves that lumpiness problem you mentioned. And according to the recent 10K, they have signed 55 of these RaaS contracts so far.
Which is a solid start. I mean, it's not a huge number yet, but it proves the model works. 55 clients said yes to the monthly fee. That's proof of concept.
Let's talk about the fleet itself. We mentioned the coffee robot, but they have more than just one droid in the lineup. It's a whole portfolio.
It's a diversified portfolio, which is smart. They aren't betting the farm on just coffee.
Mm.
The star of the show, as we mentioned, is Adam.
Adam.
This is the beverage preparation robot. It's dual-armed, it has a friendly demeanor, and it's conversational. It's the front-of-house star.
This is the one deployed at Walmart and Ghost Kitchens.
And NVIDIA HQ. And think about that for a second. NVIDIA, the king of AI chips, is using Adam.
That's a heck of an endorsement.
It is. What's interesting about Adam is that it offers what they call retail theater. It's not just a vending machine. It dances, it waves, it engages, it draws people in, it becomes an attraction.
I've seen videos of it. It's surprisingly charismatic for a machine. It doesn't have that creepy, uncanny valley vibe. It's designed to be approachable.
They did a good job on the industrial design.
But they also have the behind-the-scenes workhorses.
Right. They have Metro D+. This is a food runner and busser. The goal here is to reduce server fatigue. Instead of a human carrying heavy trays back and forth to the kitchen 100 times a night.
Which is brutal work.
Brutal. The robot does the hauling, and the human handles the customer service at the table. The high-value interaction.
Saving the humans' backs. I worked in a restaurant in college, and I can tell you, the physical toll is very real.
Precisely. It's about augmenting the human, not just replacing them. Then you have Titan, which is for heavy lifting in hotels and logistics, moving linens, bulk goods.
The grunt work.
The pure grunt work. And DUSTE, which is their commercial cleaning robot. Think of it as the janitor that never sleeps.
And new for 2026, we have Dex. This one feels different.
Dex is the big swing. This is a mobile humanoid utility robot. Unlike the others, which might be on wheels or fixed to a counter, Dex is designed for unstructured environments. It's a general-purpose robot.
So we're talking about a direct challenge to Tesla's Optimus.
Exactly.
Yeah.
Dex puts them in the same ring as Tesla. It's a much harder engineering challenge because walking on two legs through a messy room is infinitely harder than rolling on wheels. But the market potential is vastly, vastly larger if they can pull it off.
So we have the robots, we have the business model, but let's play devil's advocate here for a minute. Why now? Why do customers actually need this? Is it just a gimmick? Is a coffee shop buying this just to look futuristic and get on Instagram?
That might be part of the initial draw, I won't deny that.
Yeah.
But the real driver here is macroeconomics. We are in a labor crisis, specifically in hospitality.
I've heard the numbers are bad.
They're staggering. Turnover in that sector is over 70% annually.
70%? That is astounding.
Yes. So imagine you're a manager. You have to replace 3/4 of your staff every single year. The hiring, training costs alone are a nightmare. It is incredibly difficult for a restaurant manager to find reliable staff who show up on time every day.
And humans get tired. They get sick, they require overtime pay, they have bad days, and it affects the customer experience.
Robots don't call in sick. They don't take vacations. They don't have bad moods. What Richtech is selling isn't just a robot. They're selling reliability and cost certainty.
Ah, cost certainty.
If you lease a robot, you know exactly what your cost is every single month. There are no surprise overtime bills. There's no workers' comp. In an industry with razor-thin margins like restaurants, that kind of certainty is incredibly valuable.
I want to touch on something that caught my eye in the report. They have this Made in Vegas strategy. Why does it matter that they are assembling these things in Las Vegas?
This is a critical operational detail that a lot of people miss. It's not just a marketing slogan.
It sounds like one.
It does, but it's more.
Sure.
Richtech imports components from China, but the final assembly, the part where it all comes together and becomes a robot, happens in their facility in Las Vegas.
Okay, so it's assembled in the USA. Why is that so important?
It's a defensive move. The U.S. has imposed aggressive 125% tariffs on Chinese imports.
125%. So you're more than doubling the cost.
You are. By importing components instead of finished robots and doing the assembly here, they are currently navigating around those massive tariffs. It's a loophole, essentially.
That is a massive difference in their cost structure compared to a competitor who might be importing a finished unit.
Huge. It helps mitigate the risk. Now, that's a risk area we will definitely discuss later because loopholes can close, but for now, it's a key strategic advantage. It keeps their costs down while their competitors might be getting absolutely slammed with that 125% tax.
And there's one more moat we should mention before we move on, the data.
The data moat, yes. With over 400 installations now, and they're aiming for 1,000 in 2026, they are building a network effect.
A network effect for robots.
Think about it. Every time Adam makes a coffee in Las Vegas, it learns something, maybe a new way to grip a cup, or gets faster at steaming milk. That data gets uploaded to the cloud, the algorithm is retrained, and then that update is pushed out to the Adam in New York.
So every robot is teaching every other robot.
The entire fleet gets smarter with every single interaction. The first robot is dumb, but the 1,000th robot is a genius. And that's where the Microsoft partnership really comes into play, supercharging that learning process.
Chapter 2. Management evaluation.
All right, the people.
You can have the best robot in the world, but if the people running the company don't know what they're doing, it's going to zero. So who is in the pilot seat?
This is, it's a family-led business. You have Wayne Huang as the CEO. He's a serial entrepreneur, holds patents in computer vision. He's the technical visionary. Then you have Michael Huang as the CFO, the financial architect.
Our brother duo.
Yes. And that brings a certain dynamic. Founders often have a long-term vision that a hired CEO just doesn't. They have skin in the game. Their name is on the door.
The legacy.
Exactly.
Yeah.
But we have to look at their track record as a public company. And there was a moment recently that gave value investors a heart attack.
The cockroach moment.
I see you've read the notes. Yes. In December 2025, just last month, they failed to file their annual report, the 10K, on time. The stock dropped 5% immediately on that news.
Why is it such a big deal? I mean, companies run late sometimes, right? It happens.
In the world of value investing, there's a saying, where there is one cockroach, there are usually more. A delayed 10K is a huge red flag. It suggests that the internal controls, the accounting back office, aren't keeping up with the growth.
So they're moving too fast for their own systems.
Potentially. It implies a lack of operational maturity. It makes you wonder, what are they struggling to count? Why aren't the books ready? Are the numbers even right?
It creates uncertainty, which the market hates.
The market absolutely despises uncertainty. Now, to their credit, they resolved it. They filed in January 2026 and the air was cleared. But it showed that they are still figuring out how to be a disciplined public company. It was a stumble.
Let's talk about how they are paying for all of this. Because building robots is expensive. R&D, assembly, marketing, it burns a ton of cash.
Incredibly expensive. And this brings us to the topic of capital allocation, which is critical for any growth company. In 2025, they raised about $100 million.
$100 million.
But they didn't do it by taking out a loan from a bank. They did it through what's called an at-the-market offering, or an ATM.
Which effectively means selling new shares directly on the stock exchange whenever they need cash.
Yes. They are essentially printing new shares and selling them to investors to pay the bills.
So silent dilution.
That's the term. Think of the company as a pizza. If you owned one slice of an 8-slice pizza, you own 12.5%. But then the company, to raise money, decides to cut the pizza into 16 slices. You still have one slice, but now you own a much smaller percentage of the whole pie. Your ownership gets diluted.
Is that a bad thing, or is it just the cost of growth?
It's a double-edged sword. A critic would say they are diluting shareholders just to keep the lights on. But the defense, and it's a valid one, is that for a cash-burning startup in a high-growth phase, this is necessary.
They need the fuel.
They need the fuel. Remember, with leasing, you pay to build the robot today. Say it costs you $20,000 in cash, but you get paid back slowly over 3 years in monthly checks. You need a massive amount of upfront cash to bridge that gap and build the fleet.
So they are betting that the future cash flow from these leases will be worth far more than the dilution they are suffering today.
That is the bet. But it's a risky one. It relies on the stock price staying high enough to raise money efficiently. If the stock falls, this strategy gets very painful very fast.
They're also making some interesting operational moves. They aren't just selling robots. They launched something called Cluffy & Tea.
Right, a franchise model. This one is interesting.
It sounds like they're trying to be the Starbucks, not just the company that sells the espresso machine to Starbucks.
It's vertical integration. On one hand, it increases their complexity. Now they have to worry about selling coffee, beans, branding, real estate, all of that.
A whole other business.
A whole other business. But on the other hand, it also expands their market. If they can't sell the robot to a coffee shop, they'll just open their own shop and use the robot themselves. It's an aggressive, almost defiant move.
It is aggressive.
It is. But when we look at the return on invested capital, ROIC, which is a key metric for how efficiently management uses money, it is currently deeply negative. We're talking negative 7% to negative 15%. They are investing $1 and getting less than $1 back right now. They haven't turned the corner on efficiency yet.
Chapter 3, financial health.
Okay, the numbers.
We've looked at the robots, we've looked at the managers, now let's look at the bank account. This is where the rubber meets the road.
And this is where things get really interesting and, frankly, a bit scary if you're a conservative investor.
Let's start with the valuation disconnect. We call this the unicorn status.
As of today, the market capitalization, the total value of the company's stock, is around $1.17 billion. That's with a B.
Over $1 billion.
Yeah.
And how much revenue did they bring in for the full year of 2025?
About $5.05 million.
Wait, say that again? 5 million. Not 50, not 500. 5.
5.05 million.
So, let me do some quick math here. They are trading at roughly 230 times their sales.
That is correct. 230 times trailing 12-month sales.
That is astronomical. Even in the craziest days of the tech bubble, that is a high number.
It is priced for absolute perfection and beyond. They are being valued like a mid-cap unicorn that dominates its industry, but their actual revenue is the size of a small local business chain.
Why is the revenue so low? That's the part I can't wrap my head around.
Well, part of it is that pivot we discussed. In 2024, revenue actually dropped because they stopped pushing those big one-time sales to focus on leasing.
Okay, so the top line took a hit for a better long-term model.
Right. It grew 19% in 2025, which is okay, but not the explosive growth you'd expect for that multiple. The market is completely ignoring the current $5 million and pricing in what they think the company will be doing in 2030.
Okay, so sales are small. What about profits? Are they making money on that $5 million?
No, not even remotely close. The net margin is negative 312%.
Negative 312%. Explain what that means in plain English.
It means for every $1 they bring in the door from a customer, they're spending an additional $3 to keep the company running.
They're lighting money on fire.
They are burning cash to build infrastructure to build the fleet. The net loss for FY 2025 was $15.75 million. And that loss is widening. It was only $8 million the year before, so they're losing money faster as they grow.
And the free cash flow is a negative $14.6 million. This sounds like a financial disaster waiting to happen.
If you look strictly at the income statement, yes, it looks terrifying, but, and this is a big but, there's a silver lining, and it's on the balance sheet.
Solvency.
Solvency. Because of those ATM offerings we discussed where they sold all that stock, they have built a massive war chest. They've roughly $100 million in cash sitting in the bank.
And what about debt?
Essentially zero.
So they have no mortgage, no credit card bills, and $100 million in the bank.
Exactly. So even though they are burning cash every quarter, they aren't going bankrupt tomorrow. They have a runway.
How long can they last?
At their current burn rate, they probably have 18 to 24 months of cash to figure this out before they run into trouble.
Yeah.
That gives them time to execute on the Microsoft partnership and scale up those Ray-Rest contracts.
So the investors are buying them time. Let's try to put a real value on this thing. You ran some DCF discounted cash flow models. What is the stock actually worth based on fundamentals?
So I ran two models, because you have to with a company like this. The first is the conservative model. Let's say they succeed moderately. They grow revenue to $50 million in 5 years.
10 times what it is now. That's still pretty good growth.
Very good growth. If they do that and start to turn a profit, my model says the stock is worth maybe $0.50 to $1 per share.
And it's trading at $5.46 today.
Right. So by any conservative fundamentals-based metric, it is massively overvalued.
Okay.
But then I ran the venture or dream model.
Let's hear the dream.
Let's say they hit $500 million in revenue by 2030. They win the market. They become the standard. In that scenario, the stock could be worth $15 to $20 a share.
So the market right now, trading at about $5.50, is basically betting somewhere in between those two extremes.
Exactly. The market is betting on the dream model. It is pricing in a very high probability of massive success. If they stumble, if they only achieve the good outcome, there is a long, long way down to 50 cents.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
The story.
We've talked about the numbers, but the market runs on emotion just as much as math. And right now, the emotion is intense.
It's a complete 180 narrative. I mean, if we were having this conversation in early January 2026, the sentiment was skeptical. People were worried about the delayed filings, the cash burn. It was a gloomy story.
And then late January hits. Today.
Today, it's euphoric. The Microsoft deal completely changed the story. We went from struggling hardware startup to AI software play overnight. And in this market, AI software commands a much, much higher premium than hardware manufacturer.
It's a sexier story.
It's a much sexier story. But there's something technical going on with the stock price too, right? It's not just people buying because they like the news. We have to talk about the squeeze.
Yes, this is critical to understanding today's price action. Before this news dropped, a lot of investors were betting against Richtech. They were shorting the stock.
Meaning they borrowed shares and sold them, hoping to buy them back cheaper later.
Correct. And in fact, about 23% of the available shares, the float, were sold short.
That is a very high number. That means almost 1 in 4 tradable shares was a bet that the price would go down.
It's a crowded short trade. So, picture the scene. You're a short seller. You're betting the stock goes to zero. Suddenly, Microsoft, one of the biggest tech companies on earth, announces a partnership. The stock jumps 10-20% in pre-market. You're losing a lot of money, fast. You panic. You have to get out.
You have to get out. To stop the bleeding, you have to buy the stock back to close your position.
And your buying drives the price up even more.
Which scares the next short seller, who also panic buys. It's a domino effect. We call it a short squeeze. A significant portion of today's 43% gain is likely driven by these short sellers frantically trying to exit their positions. They're all trapped in a burning building, and everyone is trying to fit through the door at the same time.
It's like pouring gasoline on a fire.
It creates a feedback loop of forced buying. And as a result, the stock is now broken above its 50-day moving average of $3.71 and its 200-day average of $3.18.
In plain English for the non-traders.
It means the stock is in discovery mode. All the old resistance levels are gone. The technical ceiling has been shattered, and the momentum is firmly to the upside, at least for now.
What are the professionals saying, the Wall Street analysts?
H.C. Wainwright has a buy rating with a $6 price target. So even with today's massive jump to $5.46, they think there's still a little bit more room to run. But the consensus is generally cautious, mostly hold ratings.
Because of the risk and the valuation.
Right. But it's worth noting, when you compare Richtech to a peer, like Robotics ticker SRV, Richtech is actually trading at a discount. Serve trades at over 300x sales. So in the crazy world of robotic stocks, Richtech might actually look cheap to some traders compared to his peers.
Chapter 5. Ownership structure.
Who's in charge?
Who actually owns this company? We know about the retail traders and the short sellers fighting it out today, but let's look at the big players.
We have to circle back to that BlackRock stake, 7.1%.
That really is the headline for institutional validation, isn't it?
It puts a psychological floor under the stock price. It signals to other funds, pension funds, mutual funds, that this company is legitimate enough for the world's largest asset manager. You also see smaller positions from JP Morgan and Geode Capital. The big boys are starting to dip their toes in the water.
But even with BlackRock on board, they don't run the show, do they? They can't force any changes.
No, they don't. Not even close. And this is a crucial detail for any investor to understand. Richtech has a dual-class share structure.
Class A and Class B shares.
Exactly. Class B shares are what you and I can buy on the NASDAQ. They have 1 vote per share. Class A shares are held by the founders, the Huang brothers. Those shares have 10 votes per share.
So the math is completely rigged in their favor.
Completely. It means the Huang brothers have absolute veto power. They control the company. As a public investor, you are a passenger. You are buckled into the back seat. If the car starts driving off a cliff, you cannot grab the steering wheel.
You cannot fire management if they underperform.
You can't. You just have to trust the driver. You are betting entirely on Wayne and Michael Fong to make the right decisions.
And speaking of the people inside the car, we noticed some insider activity in the filings.
Yes. We saw that the COO, Phil Zhang, sold about $500,000 worth of stock back in September 2025.
Is that a red flag or just noise?
I'd call it a yellow flag. Like, executives sell stock for many reasons. To buy a house, pay taxes, diversification. It's not necessarily a signal of doom. But heavy insider selling during a supposed high growth phase always makes you wonder, if the future is so bright, why are they cashing out now? Why not wait until the stock is $20? Just something to keep an eye on.
Chapter 6. Risk assessment.
All right, the scary part.
We've been pretty optimistic about the Microsoft deal and the RAS model, but let's play devil's advocate. What could kill this company? What keeps the CEO up at night?
There's one massive geopolitical cloud hanging over them that could change everything in an instant. The 125% tariffs.
We touched on this earlier. The U.S. has slapped these huge tariffs on Chinese imports.
Right. And while Richtech currently uses the Las Vegas loophole, assembling components here to avoid the tariff on finished robots, that is a fragile shield.
What if the government changes the rules? A new administration, a new trade policy?
That's the risk. If the U.S. trade representative decides to apply tariffs to the components as well, or closes that assembly loophole, Richtech's costs could double overnight.
Double.
Easily. If their cost to build a robot jumps from $20,000 to $40,000, their entire unit economics are destroyed. The RAS model might stop making sense because the lease price would have to be too high for a coffee shop to afford. This is a binary risk. It's either fine or it's a complete disaster.
That is terrifying. What about competition? We mentioned Tesla.
The 800-pound gorilla in the room. Tesla has effectively infinite capital and a manufacturing scale that is almost unimaginable. If Optimus works, and that's still a big if, Tesla can churn out millions of them at a low cost. Richtech is trying to build 1,000. It's very hard to compete on price with a company that has that kind of scale.
And there are others, right? This isn't a one-horse race.
Not at all. Serve Robotics is backed by Uber. They have a strong foothold in the delivery market. Boston Dynamics has incredible technology. So Richtech has to carve out its niche in hospitality and cleaning very, very quickly before the giants arrive and decide they want that market too.
And then there's just the raw execution risk. It's one thing to have 400 robots in the field. It's another thing entirely to have 1,000 robots running 24/7 across the country.
That's right. Robots break. They need maintenance. Software needs updates. If a robot breaks down in a coffee shop in Iowa on a Saturday morning, who fixes it? Building that national support network is incredibly hard and incredibly expensive. If the robots aren't reliable, the customers will cancel the leases and the whole model falls apart. It's a logistical nightmare waiting to happen if not managed perfectly.
And finally, the financial risk. We talked about dilution.
They are, for now, addicted to dilution. If the stock price drops, let's say the hype fades, and it goes back to $2, a share raising cash becomes much more expensive. They would have to sell more than twice as many shares to raise the same amount of money.
Which dilutes existing shareholders even more.
Exactly. This is called a death spiral. They need the stock price to stay high to fund their growth cheaply. In a weird way, the hype is part of the business model.
Chapter 7, Conclusion.
Let's land the plane.
We have covered a lot of ground. We've seen the shiny robots, the scary balance sheet, the massive Microsoft news, and the looming tariff threats. Let's bring it all together.
Huh.
What is the bull case? Why would someone buy this stock today?
The bull case is about vision and velocity. You have massive validation from Microsoft and BlackRock.
Yeah.
That takes the, is this a real company, risk off the table. You have $100 million in cash, which gives them velocity, the speed to execute their plan. And they are pivoting to the right model RAS with what appears to be the right technology agentic AI.
So if they pull this off, they aren't just a robot company.
No, if they execute flawlessly, they become the standard oil of service robotics. They become the essential infrastructure that runs the entire hospitality industry. A decade from now, every hotel and restaurant could be running on Richtech. That's the dream.
And the bear case, the reason to stay away.
Gravity and valuation. You're paying 230 times sales for a company that loses $3 for every $1 it earns. That is a bubble price, plain and simple. The Made in Vegas tariff shield is fragile. And if anything goes wrong, if the tech glitches, if tariffs hit, if the economy slows down and restaurants stop signing leases, the stock has no fundamental support. It could fall 90% and still not be cheap.
So what is the final verdict for our listeners who are strictly value investors, the disciples of Warren Buffett and Benjamin Graham?
For the Buffett value investor, this is a hard pass, an easy pass. There's absolutely no margin of safety here. There are no earnings. It is pure speculation on a distant future. Run away. Don't walk. Run.
But for the aggressive growth investor, the person looking for the next 100x return, the venture capital style bet.
For that person, it is a compelling play. You have to think of it as venture capital in public markets. You are making a bet that in 2030, this company will be a titan. The current price of $5.46 isn't based on today's reality at all. It's a probability-weighted bet on that future dominance. If you have the stomach for extreme volatility, the narrative is very, very strong right now.
It's a high-risk, high-reward lottery ticket, essentially.
With some very smart people buying tickets alongside you.
A great point. Before we go, I want to leave you with a provocative thought. We've spent this whole hour talking about robots serving coffee and cleaning floors. But with this Microsoft Agentic AI partnership, I have to ask, is the real value even the robot?
That is the fascinating twist, isn't it?
Or is Richtech secretly becoming a data company? Are they building the brain, the operating system that will eventually run other people's robots? Maybe the hardware is just the Trojan horse to get the software into the world.
If they can monetize that data and that software, brain licensing it out to other hardware makers, the hardware margins won't even matter. That is the trillion-dollar possibility. The hardware is the body, but the software is the soul. And the soul is infinitely scalable.
Something to mull over as you watch the charts.
Indeed.
Thank you so much for joining us on this deep dive into the numbers behind the robot revolution. It's a wild story, and it's only just beginning.
Always a pleasure. Thanks for having me.
And as always, a quick reminder, this analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions. We'll see you next time.